Good morning, everybody. Hi, it's Jeff Fitzpatrick. It is Tuesday, the 28th of January, 2025. Of course, I normally do these videos on Mondays. This week, with that much volatility lying about, that I don't want to make my trading decisions until we see that volatility come through to premiums, which I'm really expecting to happen on Wednesday of this week. But nonetheless, there's still plenty of interesting things to do and to look at. So let's move on. So we're going to look at the market, we're going to look at some stock picks, and we're going to look at some aspect of the clubs. So first of all, the market. This is the S&P 500 as it closed yesterday, and you can see we have a considerable gap down. And that is caused by this DeepSeek disruptor app on artificial intelligence coming through and really hitting hard the US technology stocks. Nvidia was the most publicized of these, and I think they fell almost 18% yesterday. We were not directly in the fire line of this, but we have been affected in one or more of the clubs. This is VRT, and you can see we have got here a bigger drop, in fact. So this stock has gone down from, just move my head out the way. This stock has gone down from about 155 to 102. So that's almost a third. So we don't own this stock, but in one club, we have sold an option on it. So let's see what we've actually done. And here it is. The club is Diamond, and the option expires on the third Friday in February. But our strike price wasn't 150, it was 110. The current price is 102. We could easily regroup on that before the end of the month, of February at least. We've got 800 shares, so 8 contracts, and we got a premium of $6.24. So our current loss position after that huge fall is $1.16 per share. So we only need the stock to go up by $1.16 per share, and we wipe out that loss. Now that is a really good demonstration of why I think it's a good idea to not be selling puts at strike prices that are considerably higher than the current price. I sell the puts at prices that are at strike prices that are either at the current price or below the current price. And that seems to work pretty well this month. Okay, so that has worked rather well for us. And we come to this week's picks. As I said, it's been very difficult this week because of the volatility, but let's have a look. So what I'm doing is I'm looking at the charts and indicators for hundreds of stocks across all of my source data. Then I'm looking for the sales and earnings trends. And then I'm looking at the Zacks ratings, the value line comments, the put premium available, the stock buying power used if I take the trade, and the annualized return on investment if I take the trade as far as the premium is concerned. And I've got a preference for expiration dates that are at the end or the start of the month, so we're not in that middle of the month expiration date when prices tend to dip. We also want good clearance. So what that means is if the current price was 20, I want to be as far below 20 on the strike price I choose as possible, while still getting a worthwhile premium. So this was my worksheet for the latest selection of these picks. So all of these started off as candidates. I then turned them to green if the stock chart looked okay. And then I looked at them again in terms of the sales and earnings trends. If they weren't so good, then I turned that green to the pinky color, and that took them out. If they were particularly good, then I make the green deeper. I looked again at the Zacks ratings, and if something was a 4 or a 5, out on Zacks. Then I took them out, and those are the ones you see in blue. So I was left then with more stocks than I usually have. This is the fourth time I've recorded this exercise, and you can see on the far right, that's what I've ended up with. And one, two, three, four, five of them are in deep green, which means that they have done particularly well on the assessments. However, that assessment is before we look at the premiums available. And here they are in more detail. So I haven't given strike prices, I haven't given premiums or rates of return or anything else because they're changing so much at the moment. But these are the candidates I'll be playing with this week. Okay, so the clubs, and this week I'm going to look at the dashboard and compare it to the Apex dashboard that we see when we log into the back office of the account. And I'm particularly interested in left-in value. Okay, so I've got a busy screen here. The top left is the Apex screen, and you can see on there, this was actually at the end of December 2024. We had an account equity of 275,000, and that compared to the value of all of our costs added together, plus the cash that we had of 321,000. So there's a huge difference there as far as I'm concerned. We're getting on for sort of $50,000 worth of difference. So how can we account for that? Well, if we take the difference between that value, 321,000, and the account equity that was showing up there, it is in fact 46,000. And the option drag is showing as 46,000, same figure within $2. So you could be tempted to sort of say that's happened there. So what all they've done is knock off this thing called option drag. I looked then again at the figures for the market closing prices of last night. The account value or the account, I call it account equity really. The value of all of the shares and the cash we have is up to nearly 400,000. And the Apex screen is showing 325,000. So it's up there by 50,000 if you look at the 2 second figures. But we now have a 74,000 difference. And the options figure shown on Apex is only now 33,000. So in other words, the options figure that we get and that we show on the dashboard doesn't account for this difference. So I've been going a lot deeper into this. Let's have a look. Okay, so this is the beginnings of a new dashboard, but I'm mainly interested in the section on current positions. So the club here is Fortune. So here are the stocks that Fortune own. There are actually 12,900 of them. You can see how much we paid, the current price, the cost, the total cost at the bottom, 270,000, the income that we've had per share on them, and therefore the exposure. The exposure is what we paid less the income we've received, and then whether we have a gain or a loss. And the value of the stock. So that's, again, current price times the number of shares held. That gets to that. And I've got the exposure, current exposure multiplied by the number of shares held, and we've got the total gain. So we're actually only 11,000 up on the shares. The income, however, has been 51,000. And then we've got this strange figure that comes from Apex, maintenance required. And it's a positive figure, 80,000. So that looks to me as though it is the amount of stock buying power that owning these shares is giving us. So it's a positive thing. If I scroll down further, these are the puts that we have sold that are current in this account. We can scroll over to the right a little bit. You can see the number of days to expiry, how many we've got. We've got 9,900. And our commitment on this is 511,000. Huge commitment. However, if we look down them, there are very few that are actually due to be put to us. So we've got ACLS, which, as things stand, and we've got 143 days to go, they will be put to us because the strike price is higher than the current price by about $6. By the way, we've had $10.55 per share in income on it. So we're not actually badly off overall. AX current is higher than strike. AZN it is. CAG it is. CMCA it is. CVS we've got two going. One is higher and one is lower, so we are due to have some of those put to us, and we've got 24 days to go. However, we've also had our $6.24 in income, so we're not losing money on it. Dell, we're okay. The current is higher than the strike price. FIVN again. Match, we've got 1 cent of difference, but we've had nearly $5 of income on it. Nice, we're ahead of the game. Root ahead. Shoe and ARX, we're ahead. So most of the time we're ahead. And the potential income from all of that is $40,000. If we take off it the income that we're losing, where we are having to accept, as things stand, a strike price that's higher than the current price, then that would come down to 36,000. So in my we've also got some calls, and calls have given us 4,571 basically as we stand current. So if we take all of that, we've got 273,000 in there, and we've got 126,000 of cash, and that tells me that we are worth nearly 400,000. However, as I say, the brokers say, whoa, you've got to keep some money back here in case all of those puts result in stock getting put to you. And that's why they reduce the value of the account that we're seeing. So although we are worth nearly 400,000, for their caution, they're taking off $74,000 worth of, if you like, insurance against us having to pay for all of these shares. However, I know that we're not due to be paying that anyway. So, and they're taking twice as much as the options involved. So, on the back of all this, I'm investigating it further, trying to get it clear in my head and clear for everybody else, and then we'll alter the dashboards to reflect a little more of reality. So the dashboard will then show what we're actually worth. However, it will also show if we were to close the account, what we would then get by giving away some of this income. Okay, next. So I'd like to mention the conference. You can book it at myinvestmentclub.co.uk. The agenda is there and it's very interesting, some really cutting edge stuff. I hope you'll come and join us. And if you haven't already joined my Facebook group, please do so. It's the Extraordinary Stock Trading System. Right, that's about it for this week. Thanks for listening.